Good morning, Chris.
Morning, good morning.
Hey, good morning to everyone. I'm just going to give it a couple more seconds to let the rest of our attendees join. So I got a couple here in the waiting room. So it's a beautiful, beautiful morning here in Florida.
Yes, it is.
Days like this is why we live here, right?
It's perfect. It's the best.
All right. All right. All right. So for our guests, I want to let you know that we'll only be here about 15, 20 minutes. If you have a question, please feel free to drop it in the chat box. And we'll try and get to that as we roll through this morning. All right. So welcome to Coffee with Chris. So this is a weekly short webinar that we do, updating everyone on something happening in the market, something happening in the mortgage or real estate world. Today's topic is definitely I shouldn't say a hot button issue, but it's definitely in the news quite a bit. And there's a lot of talks about it. And of course, with that comes a lot of misconceptions and rumors and everything of that nature. So I'm really excited to talk about this, Chris.
Me too.
All right.
Thanks for joining us, everybody.
Yeah.
We appreciate you being on.
All right. So, Chris, so the topic today is talking about the federal rate hikes, the increases. Obviously, the topic was brought up just a couple months ago, and then they're still in talks, and then we had some new things happen. So can you give us just a brief overview on, where we are May 12th today, what's happened so far?
Yeah, so literally from the beginning of this year, I believe March was the first hike. The first hike was at 0.25%. And then just recently, just the other day, I think 2 days ago, they raised it up another 0.5%. So if the Fed follows through with what they say they're going to do, that total amount is going to be between 2.5 to 2.75 by the end of the year, which the crazy thing is the last time that this is the biggest increase today since 1994. And we're looking at something that would probably be more than what happened in the late 70s, early 80s when we went through this type of period of inflation. So, the big misconception is when people hear that the Fed fund rate is going, when they're raising that rate, everybody panics, especially in real estate, because they're feeling as though that this is going to have a major effect on home prices. And when the Fed did it last, like 2 months ago, it did. And it didn't have the effect because of the Fed fund rate. There was a couple moving parts there. And I know that we have discussed it on a couple other things, but I just want a refresher for people so they don't think that it's going to change as dramatically as it did with the 0.25% hit as it did just now with the 0.5% hit. So the mortgage rates are, go ahead, Mindy.
Can you just give us a brief overview when the media talks about like the Fed rate? Yes. What is that? Like, give us that overview.
Okay, so the Federal Reserve, it's the central banking system of our country here in the United States, and it's a quasi-government organization. So what their job is to do is regulate the financial industry, right? So banks and other banks, and they want to make sure that they can help them manage the supply of money that's in the U.S. and control the overall interest rates. So what happens, Mindy, when the Fed raises the rates? It's actually the money that other banks need to borrow to keep their reserves up to par. So it's what the banks have to pay for borrowing money to keep their reserves where they need to be. And people out here, us consumers, just hear this and we think, oh no, our interest rates are going to raise on our homes or on our buying a home, which the truth is they will go up. So it does affect some things, but not your mortgage. So where you will get affected would be when you buy a car, because if the banks have to borrow money at a higher rate, they're passing that through to you on those things that are tied to it, such as sorry about that, guys, such as consumer debt. Consumer debt would be affected by that. So like credit cards, you might see a spike in credit card debt. So I would encourage people to try to, eliminate as much debt as they can so they don't create new debt. Right. So if you can pay down your cards and try not to use them as much, because you will be affected there. You're going to feel it at, when you go to buy a car, those interest rates at 2% might be 2.5 or 3, because they're going to pass through their cost of, what they're borrowing the money from other banks onto us as consumers.
So this is not an interest rate that's direct from banks to consumers then?
Absolutely not. You're going to see it. So you're going to see it on your, consumers will see it on purchases. Like I said, credit card debt, and when they're purchasing a car, things like that.
So how does this affect? So obviously that affects the consumer side, like credit cards, cars, like other types of loans. How does this affect the mortgage industry or someone who's thinking about purchasing a home?
Well, right now, the interest rates, as we know, they went up so much in the last 4 or 5 months. Actually, 6 months is when they started to rise. But the real reason for that was, if a lot of you guys on this call remember pre-COVID, the rates were I was selling probably 4.3, 4.75, and the rates were not that far off on where they were today. And as soon as COVID hit, the government decided to buy mortgage-backed securities, which has a huge effect on our rates. And they did that to help not just shut down the economy, because everything else was shutting down and they just didn't want to halt everything. So by them buying and purchasing these mortgage-backed securities, it dropped our interest rates down to a level that we've never seen in the history of mortgage rates. So it was a heyday. People started keeping buying houses, and we've seen what happened, right? We've seen the increases in property values shoot up in some markets 30% in the last 2 years. And we're all sitting back saying, should I sell my house? Because I make all this money, but where do you go, right? Because the prices are still there. And if you did sell, you're going to have to take a higher interest rate. So a lot of you that might have bought in the past few years have a nice interest rate in the 2s. And that's a very nice rate that we may not see again. I never do guarantees in this business, Mindy, because, I've seen crazy things happen. If you would ask me if 30-year fixed rates would have been in the 2s 3 years ago, I would have said, no, I don't think we'll ever see that. But there we were when we did. So what you want to look at when you're thinking about buying a home is, right now, the government's not going to be buying any mortgage-backed securities. They really want to slow things down so we don't go into a major recession. And when you have people, and think about it, we're finally seeing prices of homes, maybe they're continuing to go up, but at a regular rate. We're going to still see home prices increase. And that's because we still have a 6 million housing shortage on new construction. There's still a shortage there. So you're going to see the natural increases, typically 3 to 5% a year, depending on the market you're in. So we will probably a little more throughout this year still in some markets, because, those hot pockets like Tennessee, Florida, Texas, you still have a lot of people moving there. And what I believe, this is just my opinion, I don't claim myself to be an expert, but I believe the first wave of people came and moved to these different areas of the country. And now you're going to start seeing the second wave, which will be family, friends, and whatnot. So I don't see it crashing in the sense that you hear things. And that's a whole different topic. Maybe for next week, we can talk about, is the real estate market going to crash and everything? That would be a good thing for us to kind of prep you on. Maybe we talk about that next week. If you like, leave some comments in there and let us know what kind of topics you're interested in, so we can really hit those points. But as far as mortgage rates are concerned, they're going to continue to climb. They're going to go up. The government's not going to go back in and start buying mortgage-backed securities. So the good news is interest rates are still at all-time lows. I encourage people, and I send it out to my clients, is go on Google and say historical history on mortgage interest rates. And you will see from, the 70s till now that, rates at a good time were 5, 5.5, 6.5. And not to keep rambling on, but I've been seeing all my posts on Facebook, my history posts keep popping up in my history, and one was 2007 or 8 when the rates hit like 6.5, and I was posting, guys, call me today. Rates have hit rock bottom at 6.5. And I just chuckled to myself, because when you tell people the rate's at 5 or 5.25, they're gasping for air. Like, I can't believe they're that high. So just remember, guys, the rates are still really good. The income index, people are still making a good living, and they can qualify for these homes in these markets. And you just really want to give somebody a call, whether it's us or someone else, to really do a review on where your income is at, where's your credit at, what can you afford, and don't let the fear mongers get to you, because these increases are going to happen. They're going to happen another, I think, 5 more times or 6 more times this year. So
we actually have a question on that. So the question is, what do you foresee happening over the next year with mortgage rates? So that's a good question. So we were starting to answer this. What do we see with federal rates between now and the end of the year? And then how do you think that's going to affect the mortgage rates is the question.
Well, right now the market is not doing well. So I'm hoping there's some people out there that still buy into the mortgage-backed securities, which again, at 5.5, we're still at all-time low rates. Believe it or not, these are all-time low rates in the history of interest rates. So we're not going into a place where the rates are going up to 8% or 9%. I don't see that happening. I do see the rates possibly we're going to see in the 6s. I do think that, and even in the 6s, those are good rates, which will then in turn probably slow the appreciation that's going on. I don't think you're going to see a huge, we're not going to go backwards. So if you bought a house today, you're not going to be worth less next year, even with rates going up. You're just not going to see those 25, 30% value increases like you did if you would have bought 2 years ago. So your equity will slowly climb, but you should anticipate the rates to go up on interest rates. I mean, since the government's not going to be buying in, we got to depend on whoever else is going to be in the market buying mortgage-backed securities.
So I had someone ask me this yesterday. So I think this is a good thing to discuss, but they were saying that they have racked up a bit of credit card debt, quite a bit, which, is not uncommon. And so we were talking about it in terms of how the federal rate hike is going to cause more pain with those credit cards. I know this might be case by case basis, but can you give us a general view? Like, if someone is sitting with a heavy load of, say, credit cards, and they're facing increased interest rates that will directly affect theirs, are there options? Like, what are some options with possible refinance? How does that look? Like, I know this was just asked to me, so there's got to be other questions or other people thinking this.
Yeah. So I believe there's always going to be a place for refinancing. So right now, if you look at some of the ARM rates that you haven't heard about in the last few years, because people didn't have to, the 30-year rates were so low that was where it was at. But these 5-year ARMs, plus you're looking at 3.75 to 4.5% with good credit. I can't quote rates on here, but that's where we're seeing those rates on those ARM programs. Now, if you have $30,000 of credit card debt and you roll it into one of these loans, you're looking at saving yourself $400, $500, $600 a month. And with the price of gas going, over $4 and the gallon of milk, I went in the grocery store and bought like 6 things the other day. I was at $75. So I'm feeling it. We're all feeling it out there. And if we have all this debt that's kind of mounting on top of us, refinancing is still a solution. You can't think of moving an interest rate from 3.5 to 5.5. If it comes down to, putting money back in your pocket a month, because these credit cards, if you have this credit card debt and you're making those payments, they're designed to take you 30 years to pay off, the same as a mortgage on minimum payments. So if you're making a minimum payment on a credit card, you're just throwing away interest. Another plus about the refinancing, credit card debt is you don't have that tax write-off on the interest on credit cards. And if you have a substantial amount of money in debt, was a big refinance company for many years, and it didn't really matter if the rate went up or went down. It was all about cash in hand at the time. So again, it's not the right solution for everybody, but if you're in a place where, you know, things are mounting and you find yourself now spending more on your credit cards and mounting more bills, and those interest rates on those cards are going up, you're just digging yourself in a hole. And sometimes it could be a solution for you. Maybe the fixed 30-year rate isn't. Maybe it's a 5-year ARM or a 7-year ARM or a 10-year ARM. You really have to look, Mindy, at the whole picture. How long do I plan on staying in this house? A lot of people, you know, they buy their first house in their late 20s and 30s. Then they buy their big house, what I've seen over 25 years in industry, in their higher 30s to lower 40s. And then they keep that house for a while. And then at some point they downsize. Kids move out and then they downsize. So think about it. Most people move every 5 to 7 years or do something with the mortgage. Realistically, I know when we turn that key for the first time, we think, I'm never leaving this house. But then life happens. There's tons of different types of life changes happen. There could be job changes. There could be divorce. There could be, you know, I'm having more kids. I need to get a bigger house. I mean, there's all these things that you really have to take into consideration. And there's ways and there's solutions to help you, you know, put that money back in your pocket, get rid of some anxiety. So like I said, one size doesn't fit all. That's why it's really important to find a professional that you like to work with, that you can get some sound advice, give you your options, let you see if it makes sense. You know, does it make sense to put, I mean, imagine $6,000 in your bank account every month that you were spending on wasted credit card debt. I mean, $6,000 a year, you could throw that on top of your mortgage and compound the debt. I mean, and compound the solution to paying that mortgage off sooner.
I mean, that's no small number, like $400, $500, $600 on, and I mean, truly $20,000 to $30,000 of credit card debt. You know, as unfortunate as it is not abnormal. Like,
correct. So here's a good example, guys, before we close up, because we're at 17 minutes. So let's say you have $20,000 of credit card debt at 3%, right? Guys, that's what the minimum mortgage, minimum credit card payment is based on, 3% of your total debt. You guys can use this for yourself. Oh, I got $10,000 of debt. 3% would be $300 a month. 20,000 would be $600 a month. Now, a mortgage based on these rates, you're looking at every 10,000 is probably somewhere around $70 a month, based on a 5.5% interest rate. So if you got 20,000, it's $140 a month to eat up $600 a month in debt. That's a huge savings, folks. That's $550 or $450 a month in savings. That's a big difference. That's life-changing to a lot of people. So again, educate yourself. Join us every Thursday. Add to the comments, email us, call us, leave us some voicemails on different or messages on our social networks to what you want to learn about. And we just want to educate you. We want to add value to your lives. And if you have any other questions in regards to this, give myself a call or connect with Mindy. She'll put you on my schedule and we can have at least a candid conversation. And,
so that's a great formula. I'm actually going to add that formula you just gave into the YouTube description when we post this video. So this is my plug for everyone. If you don't yet, go on and follow Chris Galley Florida Mortgage. I'm sorry, Mortgage Dreams on YouTube and subscribe. We'll also post this video on Facebook and Instagram for you guys to follow and watch that later as well. And of course, you're always welcome to share it with people that you think might find helpful. So we are almost at 20 minutes. So I'm going to close this down for today, but thank you everyone for coming. Thank you so much for Chris for sharing your knowledge with us and taking the time.
Thank you guys. We appreciate you.
Next week.
Make it a great day.